Hi everyone, this is Victor Colella, and I'm a financial planner here at Advisor Investments. Welcome to another Advisor You Can Talk To podcast. Today I'm joined by two esteemed colleagues of mine, Jeff DeMaso, who's our Director of Research.
Hey, Victor.
Hi, Jeff. And of course, he's back, Andrew Busa.
Good to be back.
He's a financial planner here in our central planning group, and we're happy to have him back. So today our topic is a little more big picture than we've covered in the past, and it's looking more broadly about finance and what it is and how you should think about finance. And really the reason why we're covering it is that finance means a lot of different things to a lot of different people. And depending where you're getting your information, that might not be the best definition to inform how you spend your time thinking about planning for running your financial lives. So hopefully today you walk away with a better idea of where you should be focusing your time in the finance world. Okay, so let's jump right in. Guys, finance means something different to everyone. What do you see out there as different definitions of finance?
Yeah, for me, the big one is investing and investments. Think the stock market. And probably for worse, but better or worse in the media, this is often portrayed as a sport almost. It's like ESPN with numbers when you watch CNBC. Every tick in the market's talked about, all the different data releases, and it's always, gotta act now, gotta act now. And we even have our investment superstars, your Warren Buffetts of the world. So another sports tangle there.
Yep.
And the other definition I think that's become more relevant in the last 10 to 15 years is financial planning. Investments generally gets all the press. It is more exciting sometimes than financial planning. You don't often find yourself at a neighbor's party talking about how well your insurance performed for you last year. You're more so talking about your investments, right?
Speak for yourself, Andrew.
Well, you're a different breed.
That's for sure.
But financial planning is becoming more relevant in people's lives. And I think this is the other big definition that we see out there of what finance is.
Yeah, and those are really the two main definitions that we find that a lot of conversations around finance break down into. So investing and financial planning. So let's dive a little bit deeper. So Jeff, why don't you start by giving us a little more deep dive on what investing is and perhaps what that looks like?
Yeah, absolutely. So investing, broadly, let's just say it's growing your savings. And within that, it's thinking about, how much in stocks am I going to buy? Which stocks am I going to buy? What bonds to own? What not to own? All those types of, investment selection or security selection types of questions. And maybe the way to frame this is to think about investing in isolation. And like you just have an investment strategy, but no financial plan. What does that look like? Well, in that case, you're just focusing on your return and how big can my portfolio be? And you might be thinking, well, of course, what's wrong with that? We all want to have the biggest portfolios we can.
Sure.
But, there's a few issues with that. One of them is it just doesn't line up well with some of the reasons you might be investing. Trying to maximize your return, going all the way for it, doesn't work if you're investing for something that is a due date, like junior's college fund.
Yeah, exactly. And it also makes it harder to weather the ups and downs. So as you're going along, the ups and downs, if the down happens right before junior's freshman year at Harvard, you've got a problem because now you've got to start spending from that account. Or alternatively, what happens if at the absolute wrong time, a tornado comes through and sweeps your house away and you didn't have the right insurance to cover it? Also, not a good time. So it doesn't work well in isolation.
No, absolutely. And there's kind of the behavioral component to that as well. I mean, those are specific times and events, but behaviorally, if you're just focusing on investing, all you're doing is thinking about your return, and you're probably defining success as beating the market, beating the S&P. But is that really why you're investing? And does that define, meeting your goals and hitting those marks? It probably doesn't.
Sure.
And then what do you do in a bear market when your portfolio is down? Like, are you okay? Are you not? You can't answer any of those questions. And it's just behaviorally very tough if all you're thinking about is maximize that return.
Yeah, and so it doesn't work well in isolation. But Andrew, let's look at the other side of the coin. So could you give us a little bit more specifics about what we mean when we say financial planning, but also let's take an example in isolation like Jeff did with investments.
Sure. So financial planning, as we define it, it's a lifelong process that you go through as you're managing your entire financial picture to ultimately achieve your goals, your dreams, however you define them. And I think the heart of financial planning really is goal planning. There's a lot of subtopics, within the financial planning umbrella, including, tax management strategies, estate management, risk management. We could go on. But really at the center of this is defining what success means to you. Now, Jeff, you talked about how investment strategy, it can't work in isolation. Financial planning is the same way. You know, if you're someone who, let's say you are saving a lot every month, you're minimizing your taxes, you have a solid estate plan, you've insured every major risk in your life, but because you didn't have the correct investment plan for you, you know, let's say you didn't have all of your money invested as it should have been, you weren't diversified, you know, Jeff, you're the expert here, but you know, perhaps you weren't able to retire when you wanted to because you weren't letting the market work for you.
If you're not taking advantage of that compound interest, sometimes you just don't have enough oomph. So what?
Right. You know, it's that idea of you're building this car, but if you don't have the engine inside of it, and the engine being investments, the car's not going to take you anywhere.
No, that's great. I really like that one. And I'm going to try and put some numbers behind it, a little bit of an extreme example. We'll also, for people who are more visually oriented, we'll put a link in the episode notes that you can take a look at. But let's take two twins, take them back, 42 years. They're age 25 at 1977. They both decide to make a pact. They're going to say, we're going to save $100 every month for the rest of our lives. But one of them is a little more nervous and decides to put all of their savings in a money market fund. The other twin decides that they're going to put it in the stock market and buy Vanguard 500 index fund. So our nervous investor, all in cash, but consistently saving, at the end of the day, after 42 years, has just over $115,000. It's pretty good.
Yeah.
They've done a lot right.
Yeah, it's better than nothing, that's for sure.
Yeah, but compare that to their twin who is investing. Well, they have just under $790,000. So $115,000 versus $790,000. It's almost 7 times. So that's that power of having the car with the engine driving you towards your destination.
Another twist to your example here, Jeff, which is there was a third sibling, a triplet, and that triplet was disowned by the other two because they call themselves twins apparently. But that triplet was at the casino when that pact was made, and they like to spend money, so they didn't make this pact to save $100. I probably don't have to tell everyone that compound interest on zero doesn't really work. So you need to be saving. So that's the engine without the car, so to speak. So maybe they would, if they had the money saved, they would invest it, but they didn't have their financial planning house in order, so they weren't really doing the saving. You know, we're talking about financial planning and investments as two separate things. They really aren't, which is hopefully the point that we're getting across here. But let's get a little more specific on the goals piece. Let's talk about the destination, and for each goal, let's talk about a couple of investment considerations and a couple of financial considerations that would really make this goal most likely to be achieved. Okay, so let's start with, we've touched on this before, let's start with college funding. This is one we see all the time. So Jeff, what are a couple investment considerations we should think about with this type of goal?
Yeah, I'd say the first one that we're probably thinking about is just the time frame. You know, are we saving for a toddler who's 3 and got years ahead of them before college comes around? Or are we talking about saving for a high school senior and college is right around the corner? That's going to dictate how much risk we're taking in the portfolios. Other considerations are if you're investing through 529 plan, which I'm sure you guys will talk about on the financial planning consideration side, but the investment side of that, you might have a limited suite of mutual funds to choose from. And so part of it comes into the selection of what are we buying.
So Andrew, what are some planning considerations with the college goal?
Well, I think back to some client conversations that we've recently had with folks about this. You know, they recently had a baby and they were wondering, okay, what sort of account should I be contributing to start saving for college? They were ready to start doing this. They had extra, cash flow at the end of every month that we determined. So, we took a look at it, and Jeff, you mentioned 529 accounts, so we took a look at those. Of course, those tend to be more tax advantaged, specifically designed for saving and paying for college. And then you have UTMA accounts, which stands for Uniform Transfers to Minors Act. Now, these are accounts where a parent can give assets to their child while maintaining control over those assets until the child reaches the age of majority. Now, these are accounts, they do come with their own set of advantages. You have a little bit more flexibility than a 529 with a UTMA. You have more investment selection. Now, it doesn't come with the same tax advantages that a 529 does. So it's sort of you have to weigh the cost benefit there. But for this particular client situation, we determined that 529 was the way to go. There are other considerations too. There's financial aid research that we've done for clients to figure out, what sort of eligibility is a student potentially eligible for. This was a client their student was closer to going to college, so the horizon was a bit shorter. So those are some of the considerations that come into the financial planning piece.
Yeah, and part of the financial planning piece could be, how much should I be saving? How much can I afford to save? But also, what are the tax implications of those accounts? What are the estate planning implications of those accounts? Can I access this money if something else happens and I need the money, or is it exclusively for the kids? So there are a lot of things to think about there.
Well, yeah, and it then informs the investment decisions you might make. If you are in a position where you can save a lot for that college fund, maybe you don't need to take on quite as much risk. Or if you've got other money outside the 529 plan that can go towards college, that can influence the investment side. So again, it's kind of circular. They inform each other.
All right, so our next goal that we'll talk about is retirement. And we talk about retirement all day long just because so many of our clients are thinking about retirement, on the verge of retirement, or are already retired. So let's do the same thing. Jeff, what investment considerations in particular apply to the retirement goal?
Again, on number one, it starts with risk. And you'll notice that's also where I started talking about the college plan, but that's not what we talked about with what's portrayed in the media. So we think risk is a big component for how people invest and what types of portfolios you're going to own and try and hold through time. So with risk, there's really two components to it. One is, how much risk can you tolerate? And that's really a behavioral question. That's kind of the sleep at night question. Everybody's different on that. Some people are risk takers, others just aren't by nature. But then the other component, and it gets really into the financial planning side, is your capacity for risk. So that's, do you have an emergency fund set aside? Do you have an insurance policies in place? Is your job stable? And now I'm probably stealing some of your guys' thunder, but that just shows how intertwined these two components are. And then from there, once you know what your risk level is, we can think about, what types of funds will help you get to that point, build that portfolio, that, all the security selection, all those types of decisions we're making.
Yeah, and one note on the risk tolerance is that changes across your life. So I've seen this happen a lot of times where clients who are very comfortable with risk while they're working, their portfolios are very much equity, so stock balanced over bonds and other asset class. As soon as their paychecks stop and the market goes down for the first time, it feels really uncomfortable, and that's something that we have to keep an eye on. So am I as comfortable with risk as I was 10 years ago? Which would be a good question to ask yourself. So let's shift gears. Andrew, from a planning standpoint, there's a lot of meat on this bone of retirement planning, but what are a few of the things that you like to have our clients think about?
Well, Victor, you just touched on one really good one, and that's, if someone's right around the corner from retirement and they're no longer going to be, getting a paycheck every other week, they now have to live off of their portfolio. We're going to help them visualize their retirement over the rest of their life expectancy to see, do they have enough to sort of make it based on the retirement lifestyle that they want to have. So a lot of it is cash flow planning. I think that's a common topic we talk about with folks. Another topic that comes into play is making sure that people's estate plan is solid. Looking at people's risk management, this comes into play with insurance, but making sure that they're avoiding the big mistakes. I know, Victor, you like to talk about that as well.
Sure, and this really does apply to risk management because your financial plan is really only as good as the weakest link. So how does your plan hold up if you get sick, if you're disabled and can't work, if you get sued, you get in a car accident, you hit a school bus, and you get sued for all of your net worth? The more that you have as you get closer to retirement, frankly, the more you have to protect. So making sure the risk side of the equation is covered is such a big part, and part of that is taxes as well. So there really are a lot of aspects here.
Right, and they really do go hand in hand, financial planning and investing, especially in their retirement planning goal. I know we've run plans for clients where they're invested maybe too conservatively, and we can show them, if you invest a little bit more aggressively, you can improve the odds of your plan based on how much you want to spend, how long you're likely going to live for. That's the kind of visualization we can give to folks.
Yeah, and I think it's worth talking about now. So we've talked about how they're so closely intertwined, but what really, Jeff, you talk about this a lot. When does the combination of a good investment plan and a financial plan really shine?
Well, the time they shine is, at those difficult moments, whether that's, a bear market or, heaven forbid, one of those emergencies. You have the tree fall on your house or something. It's these difficult times where the combination of the two really comes through.
Yeah, and when talking about risk specifically, which we've talked about a lot here, there are two reasons that folks sell all of their assets at the bottom of a bad market, which is about the worst time you can sell them. And that's one, because they're scared, so because they're nervous and the emotional side that Jeff talked about. And the other reason is because you have to. This same tree has fallen on a lot of houses today, but that's a good example of you've got to put your roof back together at the absolute worst moment. Guess what? That means you're going to have to sell some of your assets at the worst possible time. So those moments where we're tested is where the two really work together well.
And we run a lot of financial plans when the market isn't cooperating, when there's a lot of volatility on the downside. Most recent correction, if it's down 10 or 15%, folks are getting uncomfortable. Victor, you mentioned that. So that's a common time for us to hop on the phone with a client, run their financial plan, and say, hey, you're still on track to meet your goals, so don't worry about what the market's doing.
Yeah, it's a good way to refocus.
Yeah, I mean, it ties into something we haven't talked about is communication, right? The financial plan is a really good communication tool for a client and how they're, progressing along their path. Well, on the investment side, we try and communicate as well, too. And that's part of that behavioral side of bear markets happen. We've built a portfolio that knows that and is built to inevitably take care of it, but also knowing that those are temporary and that the markets tend to go up over time.
Yeah, I love the quote. The worst time to do a lifeboat drill is as the ship is sinking. So from the financial planning side, what we're doing is we're saying this is what your portfolio would look like if it went down by 20%. You're still okay to meet your goals. So doing that before those tough times is really critical. All right, guys, thank you very much for your input here. I think if anything that we've communicated here is that financial planning and investing are two sides of the same coin. So if you have any questions about either, we're happy to help, but I hope you got something from our podcast. So this has been Victor Colella, Jeff DeMaso, and Andrew Busa from Advisor Investments, and we're thanking you for listening to another Advisor You Can Talk To podcast. If you've enjoyed this conversation, please subscribe, review our show. You can also check us out at www.advisorinvestments.com/podcasts. We love getting your feedback, and it truly is always welcome. It helps inform our future episodes. So if you have any questions or topics you'd like for us to explore, please email us at info@advisorinvestments.com. Thanks for listening.